Here's a number I want you to sit with before we get into anything else. The average American household makes somewhere between 450 and 550 distinct retail purchases every year. Groceries, household goods, clothing, digital subscriptions, online orders. Conservative estimate 500 transactions. And of those 500, roughly 60 to 70% involve a price ending in 0.99, 0.98, or 0.95, something deliberately designed to stay below a round number. So we're talking about 300 to 350 individual moments per year where a pricing signal is specifically engineered to influence how your brain categorizes what something costs. Not occasionally, not in niche categories, in the majority of the purchases you make every week, all year, for your entire adult life. That is not a marketing curiosity. That is a structural feature of how consumer spending works, and it has a measurable effect on household budgets that most people have never calculated. Today, we're going to do the calculation. My guest is Daniel, a financial advisor who has spent years doing spending reviews with households across income levels. He tells me that 0.99 pricing is one of those patterns that once you start looking for it in someone's budget, you see it everywhere, and its effects are larger than most people expect. Daniel, welcome.
Thanks for having me. And that framing is exactly right. When I sit down with a client for the first time and we go through their transaction history, and I mean really go through it, line by line, the clustering around 0.99 price points is one of the first patterns I flag. It's not one big number, it's 100 small ones. And that distribution is what makes it interesting and what makes it worth understanding.
Let's start with the foundation. When a retailer prices something at $9.99 instead of $10, what is actually happening at the cognitive level?
The core mechanism is something behavioral economists call left-digit bias. The name's fairly literal. When your brain encounters a multi-digit number, it anchors on the leftmost digit, and it does it fast. Before you've consciously processed the full price, your brain has already filed it into a rough mental category based on that first number.
So $9.99 gets categorized as a $9 item rather than a $10 item.
Exactly. And the perceived distance matters. Research has shown that the psychological gap between $9.99 and $10 registers as larger than the gap between $10 and $10.50, which means a 50-cent increase feels less significant to the brain than a 1-cent increase, purely because of where the digit boundary falls. The brain isn't doing arithmetic, it's doing category assignment. And 99 pricing is specifically designed to exploit the seam between two categories.
How long has this been understood?
The practice goes back further than the psychology. The historical origin of 99 pricing, and this surprises a lot of people, has nothing to do with consumer perception. It started in 1870s and 1880s American retail as a theft prevention mechanism. If everything was priced at round numbers, a dishonest cashier could pocket cash without opening the register. No change needed, no transaction record. Price something at 99 cents and the customer needs change. The drawer opens, a record gets created.
So it was accountability infrastructure first. Psychology came later.
Much later. By the mid-20th century, researchers started studying why 99 priced items consistently outperformed round number equivalents in sales data. That's when the behavioral economics literature caught up to the practice that was already everywhere. Two completely separate phenomena converged into one very durable pricing convention.
Here's the skeptic's question. Does this still work in 2026? Most consumers today have at least a passing awareness that $9.99 is basically $10. Are people not just mentally correcting for it?
This is the question I get most often, usually from clients who consider themselves financially savvy and feel like they're above this kind of influence. And the answer is, awareness reduces the effect slightly, but it doesn't cancel it. The left-digit categorization happens before conscious reasoning engages. You know $9.99 is essentially $10. Your brain has already filed it as a $9 item. Both things are true simultaneously. The knowledge is real, the automatic response is also real. They operate on different timescales.
Which is uncomfortable to accept.
It is, but it's consistent with how most cognitive biases work. Understanding loss aversion doesn't stop you from feeling the sting of a loss more acutely than the pleasure of an equivalent gain. The knowledge is real, the automatic response is also real. They operate on different timescales.
Let's push on this further. We're in a world now where prices are compared instantly across multiple platforms, where e-commerce algorithms are doing real-time optimization. Does the 99 effect hold in that environment the same way it held in a physical store in 1985?
Mostly, yes, with some important distinctions. In digital retail, the left digit effect is actually amplified in certain contexts. When you're scrolling through a product grid and making micro decisions at speed, the brain is relying even more heavily on first digit anchoring. You're not standing in a store reading a label carefully. You're making a basket decision in under 2 seconds. The cognitive shortcut becomes more useful, not less.
So digital shopping didn't disrupt the psychology, it accelerated the conditions that make it work.
In high volume, fast decision categories, yes. Where it gets more nuanced is subscription pricing. If you sign up for a service at $9.99 a month, the 99 ending helps with initial conversion. It gets you over the sign-up threshold. But once you're a subscriber, the anchor shifts. You're no longer evaluating $9.99 against $10. You're evaluating whether the service is worth what you're already paying, which is why you've seen subscription services willing to raise prices from $9.99 to $13.99 in a single step. The threshold that mattered was the sign-up, not the ongoing charge.
If everyone in the market understands this mechanism, academics, marketers, consumers with access to the internet, why hasn't it eroded collectively?
Because the gap between knowing about a bias and overriding it in the moment is significant. And retailers have the benefit of scale. They're running A/B tests across millions of transactions. When I sit down with a client and pull their transaction history, I'm working with a few hundred data points. Retailers are working with billions. They know with high precision that 99 endings outperform round numbers in conversion. Not because every individual consumer is fooled, but because the aggregate effect across a population is consistent and measurable. Individual awareness doesn't aggregate into collective immunity.
Let's make this concrete. Walk me through what this actually looks like in a real household budget.
So, the pattern I see most clearly when I do a spending audit, and I do these regularly with new clients, is what I'd call 99 clustering. A household will have a week of grocery receipts, and when you lay them out, you'll see $7.99, $4.99, $12.99, $2.99, $9.99, item after item sitting just below a round threshold. Each one individually seems unremarkable, but when you add up the basket, the total is higher than the client estimated, almost every time.
Because mentally they were filing each item at the lower number.
Right. I had a client recently, dual income household, both of them careful with money, they thought, and we went through 3 months of grocery and household spending together. When I flagged all the .99 and under items and asked them to estimate what they've spent in that category, they were off by about $180 over 3 months. Not because they were irresponsible, because the pricing was consistently nudging their mental accounting toward the lower digit. $180 over 3 months is $720 a year, just in the grocery and household category alone.
And that gap between what people think they spend and what they actually spend, that's the number that compounds.
That's exactly the number, and it shows up across categories, not just groceries. So let's run the broader math. The average household makes around 500 retail purchases a year. Behavioral economists estimate that charm pricing increases purchase likelihood by 5 to 15% compared to round number pricing at the same value. Let's use a conservative 10%. That implies roughly one additional low deliberation purchase per week, a $9.99 or $14.99 item that makes it into the basket because the .99 framing lowered the friction.
One extra purchase a week, what does that become?
At $10 average for influence purchase, that's roughly $500 a year in spending that's driven less by deliberate choice than by pricing perception. At a modest 7% investment return, that $500 a year becomes approximately $7,000 over 10 years. Over 20 years, and I want people to actually sit with this number, it becomes close to $22,000. Over 30 years, just under $50,000.
Half of that is compound returns on what initially looks like a series of small, inconsequential grocery decisions.
And if someone is a slightly heavier spender, if the nudge is working harder?
If the influence amount is $15 a week instead of $10, which is well within range for a household making frequent small purchases, you're looking at $750 a year. Over 20 years at 7%, that's over $32,000. Over 30 years, more than $70,000. The math isn't dramatic in any single year. It's the compounding that turned a pricing convention into a meaningful wealth gap.
That is a genuinely significant number to trace back to a penny.
Which is the point. The penny is a signal, not the cost. The cost is in the behavioral pattern the signal creates, repeated across hundreds of transactions, across decades of purchasing life. And the reason I run these audits with clients is that most people have never actually calculated their aggregate exposure to this pattern. Once you see the number, it's harder to ignore.
Is there a practical way for someone to actually measure this in their own spending?
Yes, pull 1 month of transactions, credit card, bank account, whatever you use most. Flag every purchase where the price ended in 0.99, 0.98, or 0.95. Count them. Then go back through that list and honestly ask, would I have bought this at the round number? For most people, 10 to 20% of those flagged items are ones they would have paused on. That pause is worth identifying, not because you need to stop buying things, but because knowing where your autopilot is running tells you where your budget is leaking quietly.
Let's flip the lens because I think the counterexamples are important to making this analysis complete. There are entire categories of products and brands where 0.99 pricing is absent or actively avoided. What does that tell us?
Luxury goods are the clearest case, and the logic runs in the opposite direction. When a brand prices something at $2,000 instead of $1,999, they're not leaving value on the table. They're communicating something specific. The round number signals confidence. This is worth exactly what we're charging. We don't need to manage your perception. The 0.99 ending carries the implicit message of value seeking. We work to stay under that threshold for you. That's the right message for a grocery store. It's the wrong message for a Chanel boutique.
So the pricing style is itself part of the brand positioning.
A very deliberate part. Brands moving upmarket often drop 0.99 endings as part of repositioning. Not because of anything in their cost structure, but because the pricing format communicates where they want to be perceived. A price doesn't just reflect value, it actively shapes how value is perceived.
Apple sits in an interesting middle position here. The iPhone at $999, not $1,000, but also not $999.99.
Apple's pricing is studied precisely because of that middle path. The 999 point achieves the left-digit benefit at the 4-digit threshold. It reads as 900 and something rather than $1,000. But they drop the cents entirely, no 0.99. That preserves the premium feel while still capturing the psychological benefit of staying under the round number ceiling. It's a precise calibration between value signaling and prestige signaling.
So when should a business actually avoid charm pricing?
3 situations. When the value proposition is built on quality or exclusivity, the 0.99 directly undercuts that narrative. When the buyer is sophisticated and the purchase is high consideration, B2B contracts, financial products, professional services, round numbers read as more credible in those contexts. And when trust is the primary asset. I'll use my own profession as an example. A financial advisor who quotes $5,000 for a service is sending a slightly different signal than one who quotes $4,999. In high-trust relationships, the round number communicates that you're not trying to manage perception. That matters.
So the same tactic that drives volume in retail can actually work against you in service contexts.
Always context-dependent. Pricing is communication. The message of 0.99 is, we are optimizing for perceived affordability. Sometimes that's exactly the right message. Sometimes it's precisely the wrong one.
Let's bring this to something people can actually use. The listener who has followed this conversation has the analysis, but what do they do with it at the moment of purchase? What's the mental habit that actually changes behavior?
When I work through this with clients, I give them 3 questions. And the goal isn't to make every $9.99 purchase a 10-minute deliberation. That's not sustainable. The goal is to interrupt the autopilot long enough to make a conscious choice. 5 seconds per question is enough.
What are they?
First, am I reacting to the price or to the value? Meaning, do I actually want this product, or does the 0.99 just feel frictionless? The 0.99 ending is designed to lower your resistance to adding something to a basket. The first question is simply, is my interest in the thing or in the way it's priced?
That's a cleaner version of do I need this? The second question?
Would I buy this at $10? If the answer is yes, buy it without hesitation. The 0.99 is irrelevant. You were going to buy it anyway. If the answer is probably not, or I'd have to think about it, that's the signal. You're not making a value judgment at that point. You're responding to a perception frame. And once you identify that, you're in a much better position to make a real decision.
And the third?
How often does this pattern show up in my week? This one's less about any individual transaction and more about budget level awareness. When I sit down with clients for a spending review, the ones who have the biggest gap between estimated and actual spending are almost always the ones whose budgets are full of 0.99 items that were low deliberation decisions. The third question is asking you to develop a sense of your aggregate exposure. How much of your weekly spending is running on autopilot because of pricing nudges?
So the framework is really a diagnostic as much as a purchase filter.
Exactly. And I'd pair it with one practical habit. Round up when you budget. Track $9.99 as $10. Track $49.99 as $50. Not because the penny matters, but because budgeting in round numbers closes the gap between your mental accounting and your actual spending. Clients who make this one change, just this one, consistently end up with more accurate monthly estimates and fewer surprise reactions when the bank statement arrives.
Is there something even more concrete for the person who wants to actually test this and experiment rather than just a habit?
Yes, and I recommend this to clients who are skeptical that this is actually affecting their behavior. For 30 days, every time you make a purchase ending in 99, write it down in a note on your phone, a spreadsheet, whatever, and mentally round it up to the next dollar in that log. At the end of 30 days, compare your actual spending in that category to what you estimated at the beginning of the month. The gap, for most people, is larger than they expect, not because they're spending recklessly, but because the 0.99 framing has been systematically understating the cost in their mental accounting. Seeing the number clearly, just once, tends to recalibrate the pattern going forward.
So the framework isn't never buy anything priced at 0.99. It's know when the 0.99 is driving the decision and know what that pattern costs you across a year.
That's the whole thing. The penny is the trigger, the pattern is the cost, and the pattern only changes when you can actually see it.
Let's come back to where we started. 300 to 350 pricing signals per year in the average household. A pattern that, compounded over decades, shapes tens of thousands of dollars in spending behavior. What's the real takeaway?
The penny itself is noise. What it represents is a systematic, well-researched mechanism for influencing the category your brain assigns to a price before your reasoning engages. It works because of how fast automatic cognition operates. It compounds because it happens across hundreds of transactions a year across decades. And it's worth understanding, not because retailers are villains for using it, they're simply adapting to how human psychology works, but because that understanding is the first step towards making decisions that reflect your own values rather than someone else's pricing strategy.
Not outrage, just literacy.
Exactly. Once you understand the mechanism, you're not being manipulated. You're navigating a known environment with clearer eyes. And that clarity, applied consistently over years, is worth real money.
Daniel, this has been one of the more practically useful conversations I've had on this show. Thank you for making the numbers real.
Happy to. It's the kind of thing that rewards a second look.
To everyone listening, pull 1 month of transactions, flag the 0.99s, run the 3 questions, and if you want to go a step further, try the 30-day roundup experiment. The results might be more interesting than you expect. See you next week.